The price crash isn't reaching the United States. Today we're going to look at a lot of numbers about this because we keep seeing that prices continue to rise nationwide every month. Where are those prophets of doom who told us prices were going to collapse? That 2022 was the worst year in history because it was the start of a huge bubble. We're not seeing that in the market. There are markets that are still showing corrections, but they're not significant enough to be alarming. That's why, as always, we're going to approach this very responsibly. Today, we'll analyze what the different sources are saying, the National Association of Realtors, what Zillow says, what Redfin says, and what various specialists are reporting about how prices are behaving. We're going to do an in-depth analysis because it's not about wanting to disprove anything. It's about wanting to see the reality. Reality is there. It's numbers. It's math. We're not talking about speculation or about what could happen. If we, as real estate agents who are with our clients every day, don't look at those numbers, chances are we're giving bad advice. If your realtor isn't advising you with these numbers, you need to make them watch this program all the way to the end so they understand how the market is working, so they understand how the United States is shaping up right now in the 2025 as a stable market. And we'll also be making our predictions about what will happen during the rest of 2025, reviewing interest rates and this whole drama that's been created around the Federal Reserve and the possible removal of Jeremy Powell. As always, I'm Gabriel Perozzo, and I'm here with my friend and business partner,
Molina. It's a great pleasure to be with you all today.
Jenny. We're facing some really complex realities because those catastrophic scenarios haven't happened. It seems like they're not going to happen. We're pretty close to a shift in economic and macroeconomic matters, with all the tariffs now much more deciphered under the Trump administration, and the Federal Reserve much clearer about its strategy for the rest of the year. But how are we seeing the market right now? What numbers, articles, and predictions do you have for us?
Look, while it's true that there's no crash and that the steep drop people were predicting isn't happening, the market has changed. And it has changed for both sellers and buyers. In whose favor? In favor of the buyers. And why is that? We've been saying for a long time that more units are coming onto the market and that there's a lot more negotiation happening, which benefits the buyer as such. Since there's more inventory, prices have slowed down, and that helps you as a buyer if you're in a buyer's shoes today. Obviously, if you're in a seller's shoes, it's not the same situation. What is true, Gabriel, is that there hasn't been a crash, but real estate in the last 2 years, or as a result of the pandemic, experienced a boom, which generated a lot of profit for people who own property or those who bought right before or during the pandemic. That boom is over now. Now we're entering a period, as you just said, of stability, where the real estate business is returning to less speculative parameters, not as speculative as in previous years, but more toward normality. With that in mind, I've brought some articles. The first one is from Redfin. And what does Redfin say? Certainly, good news for home buyers. Sellers are starting to offer lower prices. What does that mean? There are two prices, as we've always said, the listing price and the sale price. What's happening with these prices nationwide? The sale price in the United States was $407,000. The price they're talking about here is the price at which the units are listed on the market. As soon as I list the units, the average is $407,000, a year-over-year increase of 2.9%. Now, when the units actually sell on average, they sell for $400,000 or $401,120, and we're talking about an increase of only 1.7% year over year. Here they're referring to the fact that if I bring these increases to the table and consider that the average salary in the United States has gone up by 4%, it means that homes are actually becoming more affordable for Americans. We're talking about average numbers here. This helps, of course it does help all buyers. It says that the slowdown in price growth, along with, well, we've always talked about how sellers tend to think, I set the price for my property and someone will buy it. So the fact that this myth has been debunked, that this habit has been eliminated, actually helps you. However, there are many sellers, and we're about to make them simply give up on selling. The thing is, sale prices are still at their all-time highs. Sorry, but they could drop soon. Redfin predicts that home sales in the United States will fall by 1% year over year by the end of 2025. This is a prediction from Redfin. We mentioned it on last week's podcast. Making predictions, you really never know given how the economy is, but the intention to buy has stayed strong, and in fact, it's been really hot lately. And where do we get this information from? Here it says, home showings are increasing much faster this year compared to the same period last year. And here you can see the numbers. Showing activity, which means property tours, has gone up 14% from the start of the year to now. In 2024, it had only increased by 4% over the same period. And additionally, Google searches have gone up 9% so far this year and are at their highest level in almost 2 years. What does that mean? As we've said, the intention is there and people are looking for the ideal moment to buy. Prices. I'm just bringing you this table that shows the deceleration of prices nationwide year over year from DIF, 3 different sources, NAR, Case-Shiller, and Freddie Mac. As we can see, what we want to point out is how the increase has been going down. In the case of NAR, in January, 3.9, February, 3.4, March, 2.6, April, 1.8, May, 1.3, June hasn't come out yet. It's estimated that these numbers will probably be negative by small percentages at the end of the year. In fact, here are two projections. The first, Case-Shiller, says that price growth will stay practically at 0. And Freddie Mac, it has dropped slightly. That means prices are expected to fall by 0.5%. But let's get back to the point. Freddie Mac says 0.5%. Redfin says 1%. On average, what we're seeing is a price adjustment, not a drop or a crash. This is the last report I have for you. It's what I mentioned about the sellers. What are the sellers saying? A lot of sellers think, my property is worth X plus 100,000. But in reality, your property is worth what the market is willing to pay. When the seller, in what's happening nowadays, often doesn't get the price they want, they simply decide to take the unit off the market, rent it out, or stay living in it until they get the price they feel is fair. And that's why this article from Realtor.com says, owner delistings increased by almost 50% as sellers who can't get their price leave the market frustrated. And it's happening, yes, even though it's increased a lot, it really doesn't affect you as a buyer. Why? Why doesn't it affect you? Because I have plenty of units on the market. So on the contrary, if someone doesn't want to budge on price, well, I just don't buy it and go to the one on the next block, which probably will lower the price. So this is really what's happening in the real estate market. I know, Gabriel, that you have a lot more information about prices.
Yes, we're actually working on all the June price data because there was a lot of anticipation regarding the summer season, which is when the most sales happen, and how prices would be affected. And indeed, we were going to see a lot of demand and prices were going to go up again, or if the amount of inventory that entered the market would be absorbed. Regarding that, we want to first explain how the demand is structured and who is buying by generation. This might not be directly related to prices, but it is important for us to review it so you can see the major affordability crisis. Buyers between 18 and 20 years old As you can see on the screen, are buying less or are able to buy less right now than buyers aged 80 to 97. In other words, those grandparents or great grandparents aged 80 to 97 are playing a bigger role in the market than what those aged 18 to 28 can buy or sell. That's serious because we should be seeing 25-year-olds, young professionals, couples just starting out, buying homes, and we're not seeing that. This is causing a generational crisis, as this new generation has faced affordability issues for the last 5, almost 6 years. During the pandemic, it was impossible to get a good job, and everything related to mobility was complicated. Then we had a period of very low interest rates, and prices went so high that it was almost impossible to buy. Now, with interest rates so high, it's not just the prices anymore. It's prices plus interest, which has excluded young people. The segment buying the most, impressively, is between 61 and 70 years old. They are surpassing, buying and selling more than the 45 to 60-year-old segment. What is interesting is that when we look at the 45 to 61 and 61 to 70 segments, we see both buying and selling, which means there is a cycle of buying and selling. People sell one house, buy another, sell one, buy another. In other words, they are not leaving the real estate sector, and that's interesting. Now, specifically looking at price, something catches our attention. The number of US markets where prices may be falling has increased to 110, compared to 31 we had in January. If we look here, we can see that in January, out of 300 markets, 31 had price drops. Then, in February, it was 42, March 60, April 80. By May, we were already seeing 96, and now we're seeing 110 markets. That is 36% of the markets. What should we be looking at this point? Which line is going to be crossed first? Will it be the line where the Fed starts lowering interest rates, or the one where the majority of markets are seeing price drops? This is where we go back to the analysis from the beginning of the podcast. Is it really a crisis? When we see 36% of the markets dropping, is it really a crisis? How are they dropping, and by how much? Here, we're looking specifically at which ones have dropped the most year over year, and we're seeing Punta Gorda, which has dropped 12%. Cape Coral has dropped 6.5, 9.56, 855. Really, when we see a drop, what we're seeing is a correction. The economically correct term is correction. A correction is usually defined as a drop between 0 and 20% in price over a specific period of time, which we typically measure over a year. And here you can see the rest of the markets, how they're behaving, and which of those markets are experiencing declines. Most of them, the drops are almost imperceptible. We can see that, on average, a market dropping by 0.1 means there are houses going up and down. And so we can see that most of the markets are down by less than 1%. Here we can see all the markets that are either down by 2% or not dropping at all. In other words, stay calm. This is a time for negotiation, not for panic. If you want to sell, see if you can wait, take a good look at your market, seek help, and figure out how you can maximize your income. If you're thinking about buying, check your market, see how things are in your area, and assess your bargaining power. A price drop is not a catastrophe. A price correction is an opportunity for buyers and a moment of analysis for sellers. Next, we look at the Zillow analysis. Actually, it was brought by the Resiclo team, but they analyzed Zillow's data. In 800 metropolitan areas and 3,000 counties, they conducted a study on price trends, and according to Zillow's index, prices for the month of May had increased by 0.4%. The important thing here is, for the month of June, they had increased by 0.4%. What matters is that you can see here how prices are following a normal trend, just like in 2010 and 2020. We are increasing less than what has been the average from the year 2000 up to today, where the average has been 1%, and we are going up by 0.4. But as Jenny said, we are already in a situation where, by the end of the year, we'll start to see price corrections, which is natural. In other words, it's possible that these same charts we look at year after year, when we analyze them at the end of the year, we might see more pronounced price corrections in many areas. I invite you to check out Thursday's podcast because there we'll specifically analyze Florida and how, being the area most affected by price corrections, just how much that price correction is happening and how much it's impacting the markets. It's also interesting to see that the folks at Zillow are showing us a 0.4, but the people at Reciclo, they're seeing it as 0.2. In other words, we're still in the positive, Jenny, but we're barely in the positive. Anyone who needs to do any kind of transaction absolutely has to seek help, and quality help, because right now, winning and losing are two sides of the same coin. It's not that we have some people winning and others losing. Really, everyone is both winning and losing within the same market. You need to have a really close look to see what's happening in your area. And as a real estate agent, if you're the one watching us, or as a consumer, buyer, or seller, you need to know who you're going to for help. We're always available to advise you with whatever you need, buying, selling, or renting. Please make sure that the realtor by your side also has top-notch credentials, so you can enter the market with complete peace of mind. There's another important area, Jenny, that we should look at, and that's the builders. How are builders seeing the market? Because they usually get ahead. They have much more methodology to be able to foresee the future of real estate. How are builders seeing that future?
Yes, in fact, I've brought you 3 articles that, above all, give you an x-ray of what's happening with pre-construction these days. Let's remember that pre-construction was like a lifeline that helped us, in a way, to overcome the housing shortage we experienced during the pandemic. The reason for this is that they focused on building units as soon as we had that shortage in the secondary market, and that helped us a lot. But nowadays, a lot of units from the secondary market are entering the market. And what are the pre-construction developers doing to handle this? This new market, or this new way of doing business? Number 1, let's start with permits. What's happening with pre-construction permits in 2025? I've brought you this article. It's from the National Association of Builders, and it says, permits are down in May 2025. I just want to highlight for you, housing permits continued a downward trend for the 5th consecutive month, which points to a broader slowdown in residential construction for 2025. And we can see this in the chart. On the left side, I have single-family homes. On the right side, multifamily, and it's divided by regions. The red represents the United States overall. Then there's the Midwest, Northeast, South, and West. And really, for single-family homes on a national average, there's a minus 6.1% in permits. When I look at multifamily, you could say the market is balanced. In other words, there's a minus 0.2% nationally, but we see that in the Midwest, there's a lot of multifamily construction, and construction has basically stopped in the Northeast. In the charts, I'm showing you this map where I break it down by state. For example, since we handle so much in Florida, we see there's a slow AA slowdown or fewer construction permits, down 12.2% compared to last year. That's quite a significant difference. And this is for single-family homes. And when we look at multifamily, there we actually have 14.5% more construction, in this case in Florida. And as we can see here, for example, New York is down 50.4% in multifamily. Next to it, Vermont is down 38.8%, a real slowdown. Let's remember that the single-family market or product is more targeted to the person who's going to live in the property. In other words, I want to buy a house to live in it myself. That's the market, or the majority of the single-family market. When I moved to multifamily, the people who build multifamily are corporations dedicated to rentals, the so-called rental community. So what I can gather from these numbers, or maybe for the future, is that yes, a lot of money is being invested by people who know that, well, affordability is eroded, and in some way, people are going to need to rent. We're going to have rental inventory. And with single-family homes, the builders know they're giving a lot of discounts on prices, as we've mentioned before. They know they somehow need to slow down home construction and normalize prices, and maybe even eliminate some of the discounts they're offering in order to keep their company afloat. So this is what's happening with permits. That's the first part of pre-construction. Now, what's happening with housing starts? Housing starts. Here we have that single-family housing starts dropped in June to the lowest pace since July 2024. And well, the June figure is 1.32 million housing units started. Out of that 1.32 million, single-family housing starts fell by 4.6% to a total of 883,000, which represents a decrease, of 10% compared to June 2024. And in the multifamily sector, there was a 30% decrease. So we're seeing fewer permits, fewer housing starts, both in single family. There's a decrease and an increase in multifamily of 30%. It wasn't a decrease. It was actually an increase of 30% in multifamily. It stays in line with what I just mentioned regarding the management of home prices for the end consumer and the push for the construction of rental units. But we have another article that talks about builder confidence. Why is builder confidence important? Because it tells me whether they are betting on the future of pre-construction. And it increased. That means that one way or another, they know they have strategies, they know how to handle the situation. And in some way, they see that our country's economy is improving, and the confidence of builders, which has been in negative territory for 15 months, has now increased. So really, it's like an X-ray to see what's happening and where we think the pre-construction sector is headed. Of course, all of this is affected by what we all know and have been saying for years is very important, which is the interest rates. Gabby, you always bring us the interest rate reports and where we're headed with them.
Yes, when we look at those analyses, Jenny, we can conclude that the builders don't know 100% what's going to happen in the future. Because we see the multifamily builders, at least in Florida, are pretty motivated, while the single-family builders are discouraged. And we see this by area. We see areas where they're growing by 200%, and we see areas where they're cutting back. That shows that each area, each builder is handling it in their own way. They're not all approaching it the same way. In other words, the United States needs housing. They're seeing that maybe Wyoming needs more housing than Texas. So they're realizing they can't use a one-size-fits-all approach. Additionally, it's also important to know that the builders of multifamily projects are generally not the same as those who build single-family homes. They tend to be different construction companies. Many multifamily projects are built by the same rental investors who hire third-party construction companies to do the work, and then they go on to rent the properties. They're not the same builders. So we can see how some are more optimistic, others are more pessimistic, and it also depends on the area. Overall, confidence has increased, Jenny, and you can see that in the interest rates, which are at 6.81. Why do I say there's confidence? Because the spread between the 10-year Treasury bond and the interest rates has been narrowing. That's basically driven by the confidence in the market. Interest rates closed at 681 on Friday, July 18th, and here we can see how the rates behave. They even dropped from 685 on Tuesday and completed the cycle down to 681. But it's the spreads that are setting the trend. Why? Because it turns out that 10-year Treasury bonds keep rising. They have a yield of 4.5. They hit 4.6, and they've been in that range, which is normally high for the economy we have. But remember that money is expensive. The Fed hasn't lowered interbank rates, and that shows in the fact that money, or the dollar, is very expensive. Domestically, borrowing is expensive. But what happens? When there's a lack of confidence, money is expensive, bond yields are high, but interest rates tend to be even higher because that spread between the bond and the interest rate has historically stayed around 1.60, 1.80. That is, if the bond is at 440, the interest rate should be about 1.60 higher than the 10-year bond for it to be attractive to investors. In 2023, that spread reached as high as 3.1%. In other words, there was no confidence, and people would say, I'll buy bonds. And when mortgages came out, people would say, no, I'd rather buy bonds. If you want me to buy a mortgage, you have to pay me much more than the return on money, because they were afraid of what might happen and that people wouldn't pay their mortgages. If people don't pay their mortgages, they face a greater risk. To deal with that risk, you have to raise mortgage interest rates so that people prefer the interest rate over the bond, or so that banks or investors prefer the interest rate. Prefer mortgage loans over a bond. It turns out they've gained confidence, realized there's no recession, no foreclosures, and people are paying mortgages on time. That spread is now down to 229. We're not at the 160, 180 margin, which is the normal range for an investor to say, I prefer a mortgage loan or a package of mortgage loans over a treasury bond. But that spread has narrowed and has helped keep interest rates from continuing to rise. Even this week has been quite volatile from the standpoint that Jerome Powell, let's put the interest rates up on the screen so you can see. Jerome Powell, it turns out, has his mandate to head the Federal Reserve until May. He has refused to lower interbank rates. He says there's still a lot of underlying inflation and that it's not the right time to do it, since inflation would flare up again. The Trump administration has confronted him directly, telling him the interbank rates need to be lowered. He has said no. But what blew up this week is an additional strategy from the Trump administration to start undermining confidence in Jerome Powell, and they're putting under scrutiny a renovation or upgrade that was done to the Federal Reserve buildings for $2.5 billion. In Spanish, that would be $2,500 million. They have spent that amount of money on renovating the offices. There's talk of corruption. There's talk of embezzlement, that it's just not possible to spend so much money on renovating the offices. They're talking about renovations with marble, with priv, with private elevators for Jerome Powell's offices, and so on and so forth. This has sparked a scandal and the possibility of Jerome Powell resigning. There's already been a lot of talk among congressmen, and also from the head of F-Chase, who is puny. Everyone is saying it. We'll have to see what ends up happening. He hasn't denied it. He's always said he won't resign, but he hasn't said anything since this past week. This Friday, several congressmen were invited to tour the Federal Reserve facilities so they could see the reconstruction work being done and where those $2.5 billion are being spent. But the goal is to undermine confidence in him, to try to get him to resign so that the Trump administration can appoint his successor as soon as possible, and we might see a rate cut. The next Fed meeting at the end of July shouldn't bring any rate cuts. None are expected. A cut is expected in September by a quarter point. In other words, get used to rates around 6.80, 6.50, because that's what we have until September. But it would be great news at year end if we see rates hovering around 6%. Any closing words for the podcast, Jenny?
If you have any questions, contact us. It's very easy. Below you'll find the direct link to our WhatsApp. And those who reach out to us know that we always give the best advice and share our experience, so you can make the right decision, whether that's buying, selling, or simply waiting to take action. So we're here for you. If you have any questions, just send us a message.
Excellent. Don't forget to like the video. Giving it a thumbs up tells the platform that this is quality content and should be recommended to many more people who might want to watch it. Also, share it. If you know someone who might be interested, send it to them and subscribe to our channel. We have 4 podcasts a week with the best of U.S. real estate, brought to you by real estate agents who are out in the field and always know exactly what you need to know. Thank you so much for watching Dondi Vivir in Miami podcast, a creation of Dondi Vivi of Indiert and Miami Real Estate.